Morning, everybody. Morning Forecast Council. We are here on August 5th, 2024, for an August economic and revenue forecast update presentation. Before we start with this presentation, the first point on the agenda would be to approve the meetings from previous meeting from April.
So moved. Second.
So we don't have Chair Strauss here with us. The Vice Chair Raka is excused and appointed Denalti as his designee. So how do you vote?
Yes.
Good morning. My apologies for being late. Actually, I went to the seventh floor and I started talking to Miss Barbara about passing. It's a big mess this morning.
And so I will hand it to you and start this.
Fantastic. And I realize this is one of the first days that I don't have Kate on my team, so I'm not sure. Probably don't have a script today, but this is opening the August 5th joint forecast council meeting. For us, this team, I'll pass it right back over to you.
Thank you very much. The first point on the agenda was to approve the meeting minutes from April 8th. Now that the full forecast council designee is here, we have moved and seconded the minutes.
So moved.
Great. Who calls for the vote?
Go ahead. I think it has been the chair of the forecast council in the past.
Okay, great. As we're doing this a little bit on the fly, because I don't have a full list in front of me. Director Cardinal.
Aye.
Council President.
Aye.
Streeter.
Aye.
Nolte, do you have a vote?
I do. I'm subbing in for Chief of Staff Raka.
Mr. Nolte.
Aye.
Councilman Member Rivera, are you on the committee or are you joining today?
This was on my calendar. Somebody
Yeah,
invited
Councilmember
me to
Rivera.
it, so I am here.
And
So do I have to vote or not? No vote?
No.
What did you say? No?
No.
Okay.
got
Great.
Alexandria Zhang, John, Cameron, you have something to share?
Good morning.
Good morning. Wonderful. With that, motion passes unanimously. Minutes are approved. The second agenda item, the update for.
Okay, so let's get to it. This is the economic and revenue forecast update, August 4 update. As usually, we will go first over an update on the recent economic developments and provide a summary of the economic forecast both for the US and for the regional economy for Seattle Metropolitan Division, which is again Snohomish County. And then as a second part of a presentation, we are going to look at the August revenue forecast. The first step is important because those economic forecasts are used as input in the revenue forecast models. So some of those changes that we'll see are driven primarily by the changes in the economic forecast, the economic outlook, rather than changes in the year-to-date collection, revenue collection. So first, the outlook for the US economy. This chart on the right summarizes the main takeaways from the July economic forecast for the US economy. Our forecast office uses the S&P Global forecast for the US economy as the main input in the regional economic models and some of the revenue forecasting models. And the forecast from S&P Global is summarized by those red dots in the chart. So there's 4 of them. Each of them represents one of the main indicators. The one on the top is the CPI inflation, which S&P Global forecasts to be somewhere around 2.7 or so. For the federal funds rate, again, you can see that red dot that represents their forecast for the end of a year federal funds rate. The remaining 2 dots are for the unemployment rate and the real GDP growth rate. So again, main indicators summarizing the outlook for 2024. In addition to S&P Global, there is Moody's Analytics forecast summarized by the yellow dots, and the Wall Street Journal median of the survey of economic forecasters as a blue dot. And the reason why we do this, we are trying to get a sense of how optimistic or pessimistic the S&P Global forecast might be relative to what the other forecasters are seeing, what they are expecting for the year. So each of those gray dots is then one of the forecasters from that survey of forecasters. There is 60, give or take, of them. For some indicators, there might be more agreement. As you can see, for the real GDP, there is quite a spread in their forecast. For the other ones, they are more concentrated. For federal funds rate, you can see there's essentially just 3 lines, depending on how many cuts they see taking place between now and the end of the year. Now, the main takeaway here is that S&P Global's forecast, those red dots, are not far away or significantly different from the other forecasts from Moody's Analytics, from the median survey, which gives us confidence that their forecast represents the general sense of where the US economy is heading for the year. Or, to be more precise, represented what the general sense was in July 2024. And there has been some recent developments, which I'll discuss, which we'll look at, and that changed the outlook a little bit. But when this first survey was done at the beginning of July, the overall sense was that the economy is performing well. The recession has been avoided. The overall recession probability has gone down from 60% a year ago to just 28%. So looking ahead 12 months future, likelihood that the US will be at some point in recession was just 28% among the economies. As a point of reference, 15% is a historical average, so 28% would be elevated, slightly elevated likelihood of a recession, but again, significantly below the 60% likelihood of a recession foreseen a year ago.
Yeah, just to hear more clearly, it was 60% win.
For a while, essentially up until inflation started coming down at the end of 2023. So a year ago, when we were presenting this forecast, it was about 60% chance of US entering a recession at a point between August 20 or July 23 and July 24.
Okay. And I know just in the last couple of years, we had the Fed meeting where they decided not to lower interest rates, and the stock market kind of did a doozy.
Yeah.
Does that change the rating today? Okay, sorry.
Yeah, that's a very good point, and that's exactly where we're heading now. So, and I'll get there in just a minute. So, looking back a little bit more at March forecast for US, now focusing on the S&P Global's forecast only. Again, that serves as a main input for our forecast. This red line shows S&P Global's expectation regarding the federal interest rate. So they were expecting federal fund rate down, federal Fed starting cutting the interest rate, and in general sense was that there would be a couple of cuts and accumulate to about 1% by year end. Now, there has been a series of rather disappointing inflation readings in the first half of of the year, which led Fed to a more cautious approach to the cuts. They delayed rate cuts, and as a result, that revised forecast that S&P Global released in the middle of July, as shown in this red line, expects rates to stay higher for a little bit longer before Fed will start cutting the interest rate, and their assumption was that the first cut will be delivered at the end of the year in December only. Fed has met recently last week and kept their interest rate unchanged. Between now and at the end of the year, they will be meeting 3 more times. The next meeting is in September. And since that meeting last Wednesday, there has been a employment situation report released on Friday, which showed that in general weaker than expected job creation, higher unemployment rate, and that was followed by a couple of reports on weaker than expected outlook for earnings of some major companies. It was followed by a report on job opening and hiring, which again was weaker than anticipated. And so all that led us then to speculations very recently, and last week was quite eventful. So there have been some speculations after that report was released on Friday, whether Fed is kind of behind on the interest rate cuts. There have been speculations that Fed will actually have to move faster to avoid a hard landing. And as of this morning, the financial markets are putting the probability of a rather large 0.5% cut at 91.5% in September. And that's up from about 74% chance just a few days ago before that employment situation report was released. So again, there is a general sense of concern that the labor market is weakening, and it's weakening maybe faster than what would be ideal. And if Fed does not start cutting rates fast, we might be heading in for a hard landing and recession. So that recession outlook is a part what S&P Global includes in their July pessimistic scenario. As you can see, interest rates are coming down fast because of the significant softening in the labor markets, significant job losses, which Fed will be then trying to kind of avoid by cutting aggressively. Fortunately, maybe not early enough. And so again, there is some concern among economists to what extent the interest rate cuts are coming maybe a bit too late. And if today the Wall Street Journal under 30 recession probability question as those economists would most likely provide slightly higher answer. Instead of 28%, we would more likely see something upwards from 33. So 35 to 40% probably be, that's again just my sense of looking at some of those news that have been reported, and some of the opinions of the economists have been asked there.
So the 35% chance of recession, is that just the Wall Street Journal's latest, or is that your
So that
concatenation of
that
the three?
would be the second one. Yeah, so
Okay.
the later.
What would be what?
My sense of what I have heard from a couple of economists that we are following, that we trust, their sense is that the likelihood of a recession is going up. We are not in a recession yet, but it's definitely, there's some reasons to be concerned. The likelihood of the recession is higher. Again, not 60% as last summer, not as low as few weeks ago before that employment report. And they're they'll be watching that very closely. And depending on how fast those rates are coming in, recession probability estimates.
Somewhere between 28 and 60%.
Well, yeah, again, 60% was highly elevated chance of a recession last year as things were looking rather bleak. Since then, US economy has shown quite resilient, strong performance for labor market. The GDP, the first quarter estimates came in just recently, again, very strong. So it's not going to go to 60%, but yeah, in the next survey, the sense of how things are going would be, well, not as great as we saw at the beginning of July.
Okay.
And so the overall balance of risk can move towards the downside.
Thank
Takeaway here. All right, so looking at the labor market, again, what the input for the models was back in when we were developing the April forecast, shown by this red line. The S&P Global was anticipating a slowdown in job creation, fewer jobs created, fewer lower employment growth. That strong performance of a labor market and the fact that it outperformed expectations can be seen here again by the change between the pink line and the red line. The expectation regarding the employment growth in the July forecast are above March forecast. Again, that was the forecast that S&P Global developed before the last employment report that was released on Friday. And so that slowdown in the job growth that's currently at 1.6% year over year. The unemployment rate that rose to 4.3% are again taken as are not taken into account in this July forecast, something that S&P Global will build into their next forecast that they'll develop and could alter their overall outlook for the rest of the year 2024. You might see that red line down or alternatively, and or the likelihood of that recession probability, the likelihood of economy following the red path, the baseline scenario, or the dark brown pessimistic scenario, probability will shift towards that
Yeah.
pessimistic scenario.
Before you move on, I've been told that it's hard to hear me on the computer, so that's why I'm speaking loudly. I'm not yelling at it. In each of these scenarios where you're presenting the pessimistic, that's all based on if we hit a recession. Is that correct? So if we hit a recession, then we're gonna lose jobs, I'm assuming?
Yeah, that's essentially what the chart is showing. And so in general, pessimistic scenarios don't necessarily have to entail a recession. In this particular case, for this particular forecast, it is a recession. You can see that by the fact that the pessimistic scenario line crosses below zero, which means year-over-year losses in employment. How deep it goes and how fast it goes tells you how deep of a recession and how severe of a recession this one. It would be this one in particular would imply at the peak about 1.5 year-over-year job losses, which is considerable. It's not the deepest recession. It will not be the deepest recession, but it would be a significant. Would have a significant impact on revenues.
The July 2024 baseline is indicating a higher level of employment than the March 2024 baseline.
Yes, that's correct.
Okay.
That's again the result of strong performance of the U.S. labor market, which up to that very last report was in general showing a lot of resilience, higher growth, stronger growth than. All right, now looking at regional economy, so moving from the U.S. Labor market to the regional labor market, there are again a couple of things that we are seeing that are concerning. First of all, there has been this cooling of a labor market in the U.S. and in the regional economy was not going at the same speed. U.S. Labor market again showed a lot of resilience. The slowdown, the cooling off was much faster in the regional economy. The chart here shows the job postings, so how many jobs opened and presumably hiring based on the data from Indeed. So Indeed publishes an index that compares, that allows us to compare different regions, different parts of the US, and how they evolve over time. And what this chart here is showing that the overall amount of hiring, that those job postings for the US as a whole are now above pre-pandemic levels. So the blue line is now somewhere around 10 to 15% above the pre-pandemic level. So more job openings than right before pandemic hit. Now for the red line, that's the Seattle regional labor market, which again includes the 3 counties, metropolitan statistical area, so Kings, Snohomish, and Pierce. That region as a whole, the number of job openings is more than 20% lower than in the pre-pandemic, right before the pandemic. And what we are seeing is that the red line and blue line are both coming down, but the gap between them is opening. So again, the cooling of the regional labor market was much faster compared to the US one. Gap is opening, it's not opening more wider recently, but it's not closing either. Again, compared to pre-pandemic, the metro area is worse off in terms of the job openings. In addition to that, the other indicator that shows weaker labor market in the region compared to the US is the unemployment rate. Traditionally, the unemployment rate in Seattle area has been lower than in the US. There has been a reversal in the last couple of months, and starting from March, we are seeing unemployment rate in the region which is above the US unemployment rate. Both of them are trending up. So the unemployment rate is right now 2.2% higher in the region compared to the US. Last indicator, and that's probably the most important one in terms of the impact on the revenue forecast, are the number of jobs, the employment in the Seattle area. The job numbers, number of jobs that we are using in the forecasting model are coming from Washington State Employment Security Department. They are releasing a report every month with their estimates of the overall employment by region, by industry. And the line here in this chart shows their March estimates for year-over-year job employment as measured not in a survey of individuals, but a survey of companies which are essentially reporting how many jobs they have. People might have multiple jobs, so it's employment in terms of the number of jobs, and it's changed year over year. So what this chart shows that back in March 24, their estimate was that the overall employment is growing somewhere around 1.3%, give or take, so around 1.5%. Now, these estimates have been revised down, and that's something that happens regularly. There are revisions to the official numbers, give more information that PSD processes. They occasionally revise their employment estimates down, they occasionally revise it up. What we have seen in recent past are a series of downward revisions, and the very last one, shown here by that red line, shows their July report estimates. That one had brought the employment growth in the last 12 months to 0.3 year over year. So significantly less employment growth than what was expected, what we were believing based on that report in March. So roughly 1% less employment growth, barely about.
So Jan, just so I'm clear, they released the March one, looking good. And then do they typically release these like on a certain sequence, or are they releasing them more than they typically do, which is what we're now seeing kind of the result of their.
They are releasing them every month.
Okay.
So we are showing here only the March and the July
Okay,
reports because March was used as input for the April revenue forecast. And July is used as the input.
so in between March and July, were you seeing them revise this down as dramatically as it is?
As dramatically. So these are 3 months. So every quarter there is potentially a large revision. Given the way how the data is collected every quarter, there is a large amount of additional information processed, and every 3 months there is potentially a large revision. In between those releases, the revision is usually much smaller.
Okay, so it wasn't really an indication it's large until they released it.
No, so if we were to go back before March 2024, like I said, there were a couple of, again, significant releases, significant revisions, and they were revisions.
Would the national trend look similar?
In terms of the revisions or the
Yeah.
job?
If there was a blue line on this, because if job postings are lower than pre-pandemic
Mhm.
compared to the US, which they're above, that was slide before, and unemployment is going up faster here than elsewhere, what would job growth look like on this chart?
Right, very good
by
question.
comparison?
That's a very good question, and that's what this chart will try to address. So the blue lines will now show the United States. Again, looking at March versus July, estimates for employment growth in that geographical area. So for United States as a whole, that slowdown in the labor market is represented here by the fact that the blue line is trending down. There are fewer job openings, slower employment growth, it's trending towards zero. Now, that resilience of a labor market that I was talking about is represented here by the fact that the line has moved up in the period between March and July for the US. If we add Seattle area to the chart and those two red lines from a previous chart, here is what we get. So now this chart shows not just the historical data up until July 2024, but it includes the forecast. So this is a summary of the US national forecast from S&P Global and our forecast for Seattle regional labor market. So those revisions are essentially going in the opposite direction, whereas US employment forecasts have been revised up, again, as of July, mid-July, because last employment report is not built in the forecast. And similarly, the only thing that we have in this chart for Seattle area is the report from mid-July for Seattle. So like behind, we don't know what the July employment numbers are for Seattle. They have been already published for US and they have been disappointing for US. Yes.
It says the Seattle area is expected to lag, but I see employment growth in the Seattle chart above Washington State and the nation. Am I reading this wrong?
Yeah, so that's that's a correct observation. So what this chart is saying essentially that throughout 2024, almost all the way to the end of the year, the job growth will be lower in the Seattle area, but will be catching up. It's the result of some trends which are different in the Seattle area compared to the US. The leisure and hospitality sector is expected to perform quite strongly. The manufacturing sector has seen some setbacks, but again, in general, the trajectory for manufacturing sector is stronger growth than where we are right now. For professional business services, the information sector, there are reasons to believe that those job losses that were in this sector, as major tech companies were laying off, there are indicators that the worst is over and that strong growth that we have seen in the past for professional business services, for information sector, is kind of resuming and would bring the job growth back above the US level eventually, just later than we were expecting before. back in April. It was smaller decrease than we were expecting. The other factor here is that with the interest rate cuts that were anticipated back in the beginning of July, lower interest rate will help stimulate the national economy and probably improve the outlook for a regional economy even more, given what we have seen in data. But yeah, the takeaway here would be that the job growth for 2024 for Seattle regional market is just 0.7%, for Washington State 1.3%, for US 1.6%. So regional employment probably significantly slower than state and national level. Very quickly here, if a recession were to occur, so if the US economy were to follow the trajectory from a couple of slides before for the employment, where the recession occurs and there are job losses in US, there will be significant amount of job losses also in Seattle area compared to the current level of employment at the bottom. It would be about 2.5% fewer jobs. Comparing the baseline and the pessimistic scenario would mean that the comparison show that it would be about 5% fewer jobs. So again, significant amount of job losses in the regional economy in case of recession.
Yeah, I've got a question about this slide, but any slide that has the pessimistic scenario. You've got a baseline, which has been updated, and a pessimistic look. Is there an optimistic look that the baseline is in the middle of? And I guess I'm trying to figure out how seriously or how worried we should be about the pessimistic scenario versus the baseline, if the baseline is something in between pessimistic and optimistic.
Right. Yes. So there is an optimistic scenario. We typically don't present it. It is in something that we can review on, and we can provide information on that. The monthly report that we are sending for national forecast updates include that optimistic scenario, but it's quite unviewed with all those extra lines. That said, so you can see at the very top, the first bullet point, there is a 55% chance of a baseline scenario and a 25% chance of a pessimistic scenario. So what that means is that S&P believes that the balance of risk is more towards downside. And that is, again, given the recent developments, that's the one that we are more concerned about. We might end up being closer to, rather than that optimistic scenario, which right now has 20% chance assigned to it, and it's 5% higher compared to March. Given the last couple of months have been in general good in terms of labor market, in terms of GDP growth. The optimistic scenario is slightly higher than the baseline, but it's the gap between the baseline and optimistic is not as large as between the baseline and pessimistic. So it's not again, balance of risk is towards the downside, and it would be the outcome that would be quite concerning. But again, to summarize, we do have the optimistic scenario. We do develop 3 forecasts for revenue with 3 scenarios, and we'll look at that the end of after we move on to the revenue. All right, few more things on the regional labor market. In terms of return to the office and trends there, we are not seeing significantly different things compared to the April. In Central Business District, there is pretty much no improvement. Starting from 2023, it's hovering somewhere around 50%. For South Lake Union and Belltown neighborhoods, the trend is general going up. Improvement in terms of the employees' presence at workplace, as Amazon and other tech companies have pushed towards push their employees to return to the office. So that's certainly good news. Now, related to that, development in office vacancy rates, again, something that leaves us worried. A recently released report on the demand for office space. There is a smart real estate platform, BTS, that provides quarterly updates to the index that they construct, summarizing the demand for office space, and they do it for US as a whole and also for a couple of large cities. On the West Coast, it's Seattle, Los Angeles, San Francisco. Then on the East Coast, it's New York, Washington, Boston, and the report also includes Chicago. So among those cities, demand for office relative to the pre-pandemic norm was the lowest in Seattle. So the demand right now sits at 47% of what it was right before, sorry, 37% right now compared to what it was before before pandemic, in the 2 years before pandemic, and it's down from 47% last quarter, and less demand for office space. Seattle is one of the cities with lowest index. Summarizes the demand for office space for US as a whole. It's 62 compared to 65% 1 quarter ago.
Do you have any idea why?
We do have some ideas why. It's essentially the fact that the companies are still reevaluating their demand for office space. They are trying to figure out what extent they need the office space that they have, and where exactly that office space in the region or US as a whole should be. What matters quite a lot is the composition, the industry composition of the jobs. Some of them are more, for some of them, remote work is just easier. And Seattle happens to be one of the cities where the share of those jobs which can be done remotely is larger compared to some other cities there. So in general, in that sample, or in that group of cities, those with larger share of jobs that can be performed remotely are performing worse compared to the nation as a whole. So San Francisco is very close to Seattle in terms of the current demand, and often trades place for one of those at the very bottom, together with Boston. Again, because of the large share of can be done remotely, companies still figuring out where exactly.
Got it.
So that also translates to the outlook for office vacancy rates. That one is coming from CoStar, and CoStar updates their forecast for office vacancy rates regularly, and we are using that as an input for our regional forecast and for revenue forecast, where we believe that they are an important factor based on what we have seen in the past, based on the statistical analysis that we perform. The office vacancy rates, when they are high, they generally imply lower sales tax, business and occupation tax, payroll expense tax, trade revenue. Pretty much across the board, all the main economically driven revenues are one way or the other, and to a smaller or larger extent affected by high office vacancy rate, affected negatively. And so, again, those blue and red lines compare US as a whole and Seattle area. The dotted line is where we are right now. And to the right of that is the outlook, which is for office vacancy rates to continue to climb and continue to climb significantly in the Seattle area. There is a large amount of leases that will be expiring, and those that are not renewed will add the office vacancy rates, which are then going to come down only very slowly. Given again, very low, significantly lower demand in the office space. Now, in addition to that, one final point here is the direction in which the red lines changed, comparing the paint a lighter red with a darker red line, we see an upward revision of anticipated vacancy rate. The exact opposite as what the forecast revisions have been for US. US as a whole, the revision has been down. The overall outlook is not particularly great, not much better than a quarter ago. Nevertheless, slightly better in the near term, where in Seattle it's again just the opposite. So that's essentially a couple of things that we are seeing and leave us kind of worried. Lower employment growth, higher unemployment rates, higher office vacancy rates, slower return to the office in general are factors which would be negatively contributing to the revenue forecast, and especially for those economically driven revenues. Unless there are some questions, I will move to the revenue forecast.
Sounds good. Yeah, folks can ask some questions along the way.
All right. So first, looking at the general fund revenues and in particular the baseline scenario forecast for 2024, the change is for total revenue, the change is 3.3 million to the plus. Taking out grants and transfers, it's a small downward revision, 0.2 million. In general, very small revision to the general fund forecast as a whole. It's less than 0.2%. 3.3 million represent less than 0.2% of the April forecast. And so not much difference as a whole. The one number that kind of is larger compared to the rest of them is the one for the business and occupation tax. Before I talk about that, I should mention here that those lines which are highlighted blue are the ones that the forecasting office is responsible for. So sales and use tax, business and occupation tax, and private utilities are the ones that are our responsibility. The blue line for fund balance transfer, that line, that row should not be highlighted blue. Should be that one should be here where the payroll tax 2021 obligations are. So that is highlighted and shouldn't be. So again, sales tax, P&O, private utilities, and payroll expense tax are forecasted by the forecast office. The rest of them are forecasted by the CBO team. So looking at those that our office is forecasting, the largest change there is for the business and occupation tax, minus 5.4 million. Revision for 2024 is about 1.5% of the April forecast. The downward revision is the result of large refund, a couple of larger than typical refunds that we received in the second quarter of 2024, together with the fact that after we looked more closely at the year-to-date actual revenue, larger than expected part were late payments, non-current payments for previous years, rather than current first quarter payments. So that's adjusted again. Looking at the total revenue received, it's to a certain degree as a result of what has already happened, the obligations in previous years, rather than the economy performing significant or performing well in the first quarter of 2021. So slightly lower than expected revenue for current first quarter, together with lower outlook for employment for the rest of the year, together with that large refund for first and second quarters, result in P&O revenues that are now forecasted to be only slightly higher year over year, and the revision has been down for between April and August forecast. Again, 1.5%, 4.5 million, significant amount on its own. Smaller share of P&O.
5 million.
5.4 million.
5.4.
And Jan, just clarifying, I think I heard what I'm going to say what I think I heard you say, and tell me if I got it right.
All right.
the negative downturn of 5.4 million in business and occupation was an administrative issue on our end, not an economic issue.
It's a combination of a few things here. So, first of all, those late payments are not really just the fact that some taxpayers might file late. And we are receiving those late payments. They're kind of business as usual. The question is to what extent, how large they are. And what we have seen in the first quarter is larger than typical late payments, which means out of the overall revenue received, the first quarter current obligations are smaller than typical share, which means we have less economic activity in the first quarter of 2020. So that means less of an economic activity anticipated throughout the rest of the year. That's also implied by the downward revision in the economic in the employment forecast. So that 5.4 million downward revision would be primarily attributed to the slowing processing issues.
Okay, thank you. Other questions just before we move on, Vice President, do you have more?
All right, so small 0.2% change up for 24. For 25, again, not particularly large revision for general fund as a whole, but now a downward revision. 5.3 million in total, excluding grants and transfers, it's 6.9 million. Now we are seeing a couple of those main revenue streams contributing to downward revision. Sales and use tax, business and occupation tax, again, are the primary ones here. Business and occupation tax, same story as before, slower employment growth in 2025, means less economic activity and results in fewer B&O taxes collected. For sales and use tax, there is an additional factor. S&P Global has revised down their forecast for retail sales, and those retail sales in US are additional thing that we are taking into account when developing our forecast for retail sales in the region, and that kind of revision, 1% less in retail sales in the US translates to lower retail sales, lower sales and use tax in our forecast. So 4.4%, which is about 1.2% of the April sales tax forecast. Now, moving on to 2026, same story for sales and use tax, because an occupation tax, the magnitudes are larger as the effect of slower employment growth accumulate over a longer period. And then result in about 8.5 million each, 8.5 for sales tax, 8.7 business and occupation tax downward revision. Those are then offset by an increase 18.4 million in the property tax, and as a result of that, the overall change for the general fund here is 15.3 million to the plus side, which is about 0.8%. So in terms of a large of change, it is as a fraction of general fund forecast, it's less than 1%, but a significant amount. And to the positive side again, as property tax forecast offsets the downward revisions in sales tax, business and occupation tax, and utility tax, and they can provide some additional information on the property tax here.
Sure, thank you. Yeah, Dan Dennis with the city's budget office, and I'd like to take this opportunity to introduce my co-workers here who do also parts of these forecasts. I have Joe Russell sitting to my left, and online we have Alex Zhang. And so we will be talking through maybe a few of these, just to give you some highlights. So on the property tax, yeah, we want to take a minute here. So the property tax line includes both the general expense levy that the council approves every year and decides on what rate of increase, et cetera, up to a maximum of 1%. And then it also includes the Medic One levy. And so the Emergency Medical Services levy. And that is coming up for renewal at a vote in 2025 for collection in 2026. And most of the changes that you're seeing here in the property tax line are due to the changes in the EMS levy. So in 2025, we have a downward minus 2.1 million revision. And then in 2026, as Jan said, we have an increase of 18.4 million when it renews. And so the dynamic that you have to understand about the Medic One EMS levy is that it's a countywide tax. And based on county assessed value, total county assessed value, that's how the rate is determined. The amount that the city receives in revenue from the EMS levy is based on the city's assessed value times that rate. And so when the county's assessed value increases, it lowers the rate. And depending on what happens to Seattle's assessed value, we get that rate times our assessed value. And so when the county's rate goes up faster than the city's assessed value, we end up getting less revenue because of just that mathematics that work out between the difference between the county's assessed value, which sets the rate, and then the city's assessed value, which determines the city's levy proceeds. So in 2025, what's happened is exactly that. The county's levy changed the rate. Our assessed values changed as well. And the result of that is less revenue for the city, 2.1 million less revenue. In 2026, what we have is maybe to whatever it's going to be, the county, but through the political process of determining what the rate is for the EMS levy, we have assumed 26.5 cents here. We don't know what it's going to be, but we've assumed a lowish range rate for the levy. And so 26.5 cents times the forecasted assessed value of the county, and I'm sorry, at the city, yields the August forecast amount. We do not include any forecast in the April forecast for the EMS levy. We've now got more information, more intelligence about it, how they're talking about it, and their committee work and everything. So we thought it was fair to put it in. That results in this $18.4 million increase. At this time, it will change, but at this time, that's what we're projecting.
Thanks, that's very helpful. So looking at 26 though, removing that property tax bump, would that put us back in the red?
Yeah, because of all the other red items in sales, business and occupation utility tax primarily, but there are some others down the line there.
And so
Which would mean the vote would fail. Right, we will definitely, we get the EMS levy unless the vote fails.
And of that 18 million that's up in the positive, how much of that would be allocated to the EMS levy?
Technically all of it.
Okay, so then
So it doesn't really make sense.
took the words right out of my mouth. Don't worry,
Sorry.
The city makes general allocation to the fire department to cover their costs. Among those
Right.
costs are EMS levy costs, or always have been. So this helps.
Okay.
It's
So it's new.
effectively a general revenue. We are giving it to the fire department so they can do emergency medical services. But at the end of the day, it increases our general fund of total available resources for general government purposes, among which are fire department purposes.
Okay,
It helps pay for the fire department, but we have a lot of other costs that this is a partial down payment on. In the fire department.
Right.
and so reading this chart with that levy understanding, I'm seeing next year in the red, the year after in the red, and this is all the baseline, not recession forecast. Is that correct?
Correct.
So even if we stay in the best situation possible, which is not recession, we're still hitting the bottom, and slow growth is so slow that it's not making an impact on our budget right now.
Yeah, and I mean, for property tax, it's, if you're speaking about the property tax alone,
I was talking about everything,
Oh,
the whole thing.
Yeah.
Going back to the whole kit and caboodle.
I think that's a fair statement.
Yeah, so going back to the whole amount and how, what this all means, so yeah, taking out the 18.4 out of 2026 would result in negative around 3 million down, so about 0.2% downward revision, so similar in size as 24, just going in the opposite direction. So across those 3 years, it would be adding up, it would be totaling around -5.5 million downward revision. 3 years total, and that's including grants and including transfers. The situation would be slightly different if we exclude those. How much? One important thing here is that it's a change between the April forecast and the August forecast. So it's not really saying that year over year we are forecasting decreases in the overall revenue. It's just a change between what we were believing the revenue will be back in April and current forecast. When it comes to the annual growth of the revenue, there is a line at the bottom, right above Seattle inflation rate forecast. So those percent amounts are the year-over-year changes in the general fund, excluding the grants and transfers. So for 2025, current forecast expects about 2.3% increase in general fund, excluding grants and transfers. For 2026, again, this includes the 18.4 in property tax, but the growth would be 4.3%.
Yeah, and what I mean, thing that I'm looking at here that seems consistent is B&O and sales going down regularly from now until 26. So even though the levy has that at 18.4, it doesn't change the fact that we're having some sales and B&O issues consistently.
Yeah, so throughout those years, the business and occupation and sales tax forecast have been revised down, and that's why we're seeing all those red numbers in those 3 lines. And we're looking at how much they change over time. For sales tax, it's 339.9, so let's say 340 million for 23, slightly down for 2024, it was about 1 million down. But then the growth is expected to resume, just again, not as strong of a growth as we were expecting before, but sales tax increasing to 352.7 and then increasing to 367 in 26. That was our belief back in April. Right now, it's a slightly higher forecast for 24. So year over year, pretty much unchanged at 340 million. For August, we have brought down the forecast by 4.4 million, but it still represents a year over year growth for sales tax.
And not as high as it's been, which is why it's leading to the
Not as high as
negative.
it's been in the past and not as high as we were expecting.
Yeah. That's a reality.
So slower growth for the main economic driven revenues.
Yeah.
Yeah.
No, that's my point.
Yeah.
Yeah, which is of concern.
It is.
I was gonna just say thank you, Jan, for pulling out the annual year over year, because I was in a very negative headspace just seeing the April to today, but the year over year, while it's not great, it's not bad.
Yeah, it's not terrible news, but we wouldn't call it good news either.
And that's
a reason to be concerned.
concern, yeah, exactly, reason to be concerned, but the issue is if for some reason we do hit a recession in the next month or something in the next month before the Feds can step in to change interest rates, if something falls out this month, then this is gonna be our best line, not a worse line.
That's a good point. So if things, if a recession would indeed occur and the employment growth would continue to deteriorate faster, even with interest rate cuts by Fed, they might be just too late
Right.
to cut the interest rates, too late to avoid hard landing to a recession, and that would translate to further downward revisions.
That would change this, is what you're saying, yeah.
It would,
Yes.
yes.
It would likely take more than 1 month to determine all of that.
That's true. So in between this forecast and the one that we are delivering in October, Fed will meet in September. Markets will closely look at how much the interest rates are cut and what the overall stance of the monetary policy is. We will receive a few more employment situation reports, which again would matter quite a lot for generals. So how good the labor market is, how strong the economy is. That can significantly alter what we're seeing here.
But the other highlight point, Jan, with that is that Seattle's been trending worse than the nation.
That was, yeah.
And that is the reverse of where we were.
So
pre-pandemic.
again, with the employment revisions for employment data, we are going to closely see how, in which direction the ESB moves their employment growth estimates. If there is another downward revision, that will certainly push us into the negative growth of employment, number of jobs shrink. So if it's an upward revision, it's going to be a little bit early,
But the issues, the things that I always look at this in terms of what do we have most control over? And that is business activity, economic growth, those, and so the indicators that I'm always looking at are the B&O tax and the sales and use, because that is a window into what are people doing out there in our economy and how it's, and so.
When the policy change,
Yeah,
the
that is
policy
most-
considerations that will help
Right.
prevent
Yeah,
further
it's the
loss.
most elastic to
Correct.
policy decisions.
Correct. That are within our control anyway. More within our control than fully.
okay, so this is a summary of we went over, and so moving on to other revenue streams, to select major revenue streams outside of the general fund. And the largest of them, the payroll expense tax. The table here summarizes payroll expense tax without the 2021 obligations. So were included in the previous slide, as they are still deposited and in case of refunds withdrawn from a general fund. All the other obligations starting 2022, they are going into payroll expense tax fund, reported separately on this slide. The forecast has been revised up for 2024 by about 9.7 million. The other large revision for 2024 is the REIT forecast revision, up by 4.9 million. We have seen a couple of large property sales in the second quarter of 2024 that brought in a couple of million above what we were expecting. So, after a long time, that larger real estate properties were sold. So that led us to improve the forecast for REIT. Other than that, very small changes for 2024 in the remaining revenues. For 25, again, an upward revision for payroll expense tax, minor downward revision for REIT. And finally, for 2026, here it's payroll expense tax revision up by 14.9. Very small change for REIT, so essentially REIT 25, 26 offsetting each other, and the outlook unchanged other than the 24 increase.
Was the REIT changed in Olympia this past session? Was it increased? I think it was.
Their forecast?
No, was the excise tax?
Legislation.
Yeah.
Legislation. I think. they-
Okay, so this is, what?
It didn't pass.
Okay, got it.
Could you talk a little bit about how I understand the payroll expense tax applies only to select businesses, and of those businesses, only to the high paid employees. within eligible businesses who pay the tax. So it's a subset of the total workforce. We saw in previous slides that the Seattle area has increasing unemployment, decreasing employment. How is this forecast put together that comes up with good news at that subset of total employment?
Right. So this particular revenue stream is unlike the other economically driven revenue streams. Changes in total employment matter less. That said, there is still the impact of changes in employment if it's within the sector that is forms the tax base for these particular revenue streams. And in general, lower employment in that particular sector would lead to lower forecasts for this particular revenue stream. Now, there's additional things that affect the forecast in terms of how important they are. The stock market outlook is the one that matters significantly more and can result in forecasts being revised in the exact opposite way as sales tax, business and occupation tax.
And is that basically that people are getting paid more so that there's more to tax, even if maybe there's slightly fewer of them?
That would be basically what's going on. So even if there are fewer employees, if the compensation per employee goes up, because a large part of that compensation is tied to stock grants, and the stock prices are growing significantly, you can see what we're seeing in that forecast.
Not today.
Revision. Well, right. So looking at the change in the stock prices outlook, and again, it's important to note here that what the chart is showing are the outlook from March. Those are the gray dots, and the July before the events of the last week, before today's stock price movements. So back in March, the overall outlook for stock market was very, very positive, very strong growth among some of the main regional employers. And that has not changed significantly between March and July. So moving from those anticipated stock price changes back in March to what's currently anticipated for the rest of the year, and calculating the overall change in the stock price 24 over 23, company by company. The stock price outlook, again, a week ago when this data was compiled, was pretty strong. The overall growth for S&P 500 in the July S&P Global's forecast was 23% for this year, up from 19% forecast in March. So overall, better outlook for stock market. These things can change significantly in the October forecast if the current situation in the financial market continues, if stock prices are trending down as they are now, if they are not recovering significantly, we'll likely see those two dots move to the left. How much to the left is hard to forecast. In general, the data here tries to provide some sense of how much uncertainty there is regarding stock price changes. The line around each dot goes from the low to the high estimate in data. This is data that is compiled from Wall Street Journal analysts who are essentially providing their outlook on stock prices company by company. But occasionally there is a large amount of uncertainty, and that's represented again by the fact that those lines can be quite long, with quite large range from the low to the high estimate. In general, as we are getting closer towards the year, those lines will be shrinking, and the point will be where they eventually end up. But we still have more than half a year to go, and there is no guarantee that the actuals are far away from those blue dots where they are right now, especially if labor market underperforms, financial markets perceive that the economy is heading for a hard landing, and there is no way for Fed to avoid that sort of because it's too late.
Mhm.
Do you end up weighting these? I mean, I see the companies that you're looking at. Some of them have bigger workforces in Seattle than others, and are therefore subject to the tax. How does that end up affecting?
Yeah,
your
so
forecast?
these couple of companies are here just as a representative example. It's not exactly the companies that are subject to the tax. Large taxpayers, the amount of taxes imposed depends on where the employer, where those employees are located. And there is a primary assigned versus hours method that the companies can use to assess their obligations. All that said, we are trying to include the information that we have to forecast the revenue, looking at what we have seen in past. We only have 3 years of tax collection, so very limited experience with this particular tax. But we have seen some statistical irregularities, how the tax base and tax obligations change. At the same time as we have seen some large movements in stock prices for those taxpayers. So we are bringing that in and trying to do our best with the limited experience, with the limited data that we have.
Great, thanks.
Yeah, Tom, Mike Sell with a question.
Yeah, Tom.
Morning, everyone. Thanks for the opportunity to chime in. So given the limited track record with the PET, what's happening with the stock market right now, what's the argument for using a baseline forecast for this revenue source as opposed to pessimistic?
So we are if this question can wait until we get about 2 slides into further into the comparison of those scenarios, that would be probably better timing. But can you just hold on with that question?
Sure.
With bated breath.
Yeah.
Right.
But I just when it sounded like where Director Peter was going with his line of questioning, correct me if I'm wrong, is that with the in the red or the negative, the downward trend in some of our revenue sources and the PET consistently outperforming original expectations or going up. What you're saying when you're looking at this graph here, with this list of companies, is a lot depends on our tech sector, right? Is that, well, I will just go ahead and say it. And so keeping those jobs here is important. It seems like I don't know if all of these companies listed here do have offices in the city of Seattle.
So yeah.
I mean, is that something that we should be taking away from this, from why this information is displayed here?
This information is here to provide some kind of, first of all, just provide some information where we are, what we are basing our forecasts on. And then second thing is there are some risks to the forecast. This chart is again here to provide some things that highlight some of those risks. It's a tax base that's very narrow, so less than around 500 businesses. A lot of them are in the tech sector, so information, professional and business services, trade sectors, and a large share of the overall revenue is just a handful of taxpayers. So it's about 70% collected from top 10 taxpayers. So those are the couple of things to take into account. The fact that how much we are going to collect will depend on the decision of those companies, the decisions where to grow, where to create additional jobs in the region matters for the tax base. And it's something that we don't have in our forecast. We cannot account for because we don't know what their decisions are, but they are certainly subject to, they will be responding to policies. All right, so before we discuss our recommendations for scenarios, our recommendation which scenarios should be adopted as the official forecast. Here's a quick comparison for those main revenue streams. The largest revenue streams that are responding to they're economically driven. So one thing that this chart excludes is the property tax, not because it's small, but it's go back. Property tax is roughly in the same ballpark as the other revenues, around 400 million source by 2026. So that compares, it's pretty much same as business and occupation tax, very, very similar as business and occupation tax, very similar as sales and use tax. It's not included here because it does not really, forecasts do not really vary that much across those scenarios, and it's mostly not saying that they do not vary at all, but much less than some of these economically driven revenues. So sales tax, B&O, and in particular payroll expense tax are the ones that are where we see the big differences between scenarios. A pessimistic scenario and an economic downturn would lead to a decline in sales and use tax. In nominal terms, decline is much less notable in B&O tax, but here we have to take into account that when we are talking about recessions, we are talking about real declines in general, not declines in nominal terms, which are not necessarily what we are seeing. Depends how deep the recession is. And then for payroll expense tax, again, the amount of uncertainty here is much larger than for any other revenue stream, given how much it depends on the stock market, and given our relatively limited experience with this tax, there is a larger amount of uncertainty involved in the forecast scenario. And so, looking more closely at what exactly those differences look like in terms of dollar amounts, the table here summarizes first pessimistic scenario relative to the baseline, and the other side of the table is optimistic scenario relative to the baseline. Overall, as expected, the impact of a pessimistic scenario would be quite significant. Would be a much larger change in the forecast than what we have seen in the general fund revenue table, with in general revisions less than 0.5%. These amounts here for total general fund, 25 million, 67, 86 million, those will be significant reductions to the general fund. For payroll expense tax, again, if the financial markets underperform, and this is not yet taking into account the recent developments in stock market prices, the lower end scenario based on that beginning of July or end of July, but before last week events, the data suggests significantly less payroll expense tax revenues collected. I have talked about the assessment of those individual scenarios by S&P Global, but just to summarize, S&P Global sees the baseline scenario as the one that assigned about 55% probability compared to 25% for the pessimistic scenario. So, there is some upside. 20% remaining. That's the optimistic scenario. But again, risks are skewed towards the downside.
Jan, I just want to jump in and check in with Tom. Tom, did the answer to your question on that last slide that meet your needs?
Probably not, but I'll get to that in 2 bullet points.
Okay.
If I
Yeah.
Yeah, and then let's check this. The forecast, the baseline forecast from July, S&P Global's forecast from the beginning of July, when compared with the Moody's analytics, when compared with the rest of the forecasters, is not far from the average, not overly pessimistic or optimistic. That's 1 point in favor of going with the baseline scenario forecast. And again, some of those forecasters might have alternative forecast, and what they provided for the survey is the most likely future path for the US economy. Again, there's a couple of things that happened since then: weaker employment reports and increased worries about a possible recession. We have seen regional employment growth revised down and regional labor market growing slower than the national one. And then those rising office vacancy rates and the initiative 137, there are some additional things that pose risks to the job growth and cities' revenues in general. Now, taking all of that together and looking at what we are recommending as a scenario to be officially adopted as the official forecast, we are still considering the baseline scenario to be the one that's going to be most likely closest to the actual outcome. That said, for individual revenue streams, there might be revenue streams which are going to be more negatively affected in case some of those risks do materialize. But as overall for general fund, given the current still reasonably solid expectations regarding the US economy's performance, the baseline scenario would be the one that we are recommending. The forecast for the payroll expense tax itself, the baseline scenario is not as closely linked to the baseline forecast from S&P Global, but it does represent, again, the overall market's outlook and an assessment of a situation in the stock market as of the time when the data was available. So we could wait, and if the data was available already to include those changes in last week, we would most likely change the forecast. What's happening in the financial markets right now with stock prices might be a bit of a panic reaction, and things might stabilize a little bit because the economic fundamentals are, again, if you're looking at them, not as bad as things look like. The increase in unemployment rate, for example, is to an extent the result of a higher supply in the labor market, which is not necessarily a bad thing. It would be different if the unemployment rate was increasing because jobs are being cut and there is a reduction of a number of jobs. But what we are seeing in the labor market in the US is job growth and at the same time unemployment rising, which means more people entering the labor force and looking for the jobs. So some of those, and again, just a speculation, some of those changes in stock prices might be just the effect of trades that are being triggered automatically once certain thresholds are hit, once some statistical irregularities suggest that there is a recession coming in. But the overall sense among economists which tracks the fundamentals is that baseline scenario is still the one that would imply recession avoided, even though there might be some significant slowdown expected. And if that becomes, and if Fed indeed cuts the interest rate by 50%, as the financial markets are expecting, there would be, the stock prices would likely stabilize and the overall outlook would not change down dramatically. That said, there is a lot of uncertainty. Yeah, now, I don't know if that answered the question, Tom, or if you have any follow-up.
Yeah, no, I appreciate the explanation, and you all do fantastic work, and it's evidenced by the forecast variances on those revenue categories with which you have a lot of experience. We just do not have a lot of experience with this one, and you can see it in that prior graph that you showed where there are the 3 different lines between the scenarios. That is a very wide confidence interval, if you will, and so I just tried to get that kind of voice in the public domain in a way to suggest that we're dealing with limited information, and a lot is hanging on the stock market in particular on this payroll expense tax category. So it just seems like it's in a different context as the other sources with regards to the baseline pessimistic and optimistic categorizations, not least of which the underlying dynamics of how those different forecasts are generated seems to be coming from a different place, and that's stock analyst picks as opposed to S&P Global's underlying forecasts, if I understood that correctly.
Yeah, so yes, we do have limited experience. We have seen years where payroll expense tax significantly outperformed the expectation, the year where it significantly underperformed the initial forecast, and then again a year where revenue collection was higher than expected. In general, even with more data available, if these compensations are tied to stock price changes, given how hard it is to forecast stock prices, this stream will never see forecast errors as small as the one that you're referring to for the other economy. It's going to remain a largely volatile revenue that can change year to year, forecast to forecast quite significantly.
Councilman Rivera, do you have a question?
Thank you. I have 2 questions. One is on the job growth. I understand what you're saying. We have more jobs available. People are entering probably at a higher rate, but it's just we have more jobs. I'm wondering over time, I know there's certain jobs that we're struggling to fill, like, we don't have enough social workers. We don't have enough construction workers. We don't have, the trades. Over time, these folks need to get, people need to choose, young people need to choose those jobs to fill those jobs over time. So how will that impact all of this if we continue to see the job growth high? We're still filling, but do you see what I'm trying to say? I don't think I'm articulating it properly, but we're going to have a lot of open jobs because we don't have the folks to actually fill those jobs. How does that impact all of this over time? That's my question. Or does it not?
We have, I have only presented here the total employment changes, year-over-year changes in total employment. We do have data for individual industries, and we are looking at those closely. That's data on the total amount of jobs. When it comes to job openings, there is less data available on that by industry at the regional or local level. There is a data source for US as a whole where we can track which industries have a large amount of job openings, but it does not allow us to see where exactly in the US they might be on the regional level. There is state level data, but for regional data, there is always a problem with limited data availability in terms of how exactly are the individual industries performing, where exactly those job openings are. So what we are trying to do is do the best we can with the data we have, which is mostly the employment data and job openings as a whole for the industry, not by industry.
Thank you, Jan. And then the other question I had was when you say the initiative 137 poses additional risks, can you talk a little bit about that?
So that goes back to those charts that we were presenting on the office vacancy rates and how the office vacancy rates are likely to increase in the future, which means that for any employer deciding where exactly to create jobs, there is going to be a lot of options available. And these employers are likely to take all the incentives, all the impacts of different policies on their incentives to create jobs into account.
Got it.
Whenever there is a policy that increases the business cost substantially, there's something that businesses will may have to make decisions where to locate for not just 1 year, but for a longer time. That's certainly a factor. There are a couple of things regarding this initiative that make it pose a risk. Unlike sales tax or B&O tax, there is no limit on taxes imposed on payroll. So the fact that it's 5% now does not guarantee those businesses that it's going to be 5%, and there isn't going to be another proposal to increase the cost. So that's probably something that they will take into account. There is no, in the proposal, there is no adjustment for the inflation, which means that the current threshold of 1 million will stay at 1 million. There is no sunset for this policy. And so eventually over time, there'll be more and more employees moving into the bracket. Now, again, something that the employers will likely take into the account, and to the extent that as economists believe that employers do respond to incentives, particular incentives, which policies which are very local in their nature, and affect only a handful of employers or not a large number of employees. Those are the kind of policies that can trigger can trigger significant response that's hard to estimate given that we don't have any statistical data on those. But we do have some reason to believe, given the past data that we have seen.
And some assumptions based on our higher vacancy rates than nationally. I mean, we're making an assumption, but.
That is something we are taking into account. The chart here shows Seattle, and this is city of Seattle vacancy rates. We do have access to data that provides us with office vacancy rates for other parts in the region, and allows us essentially to see where exactly there might be a lot of space available or how much space there might be available. These companies, again, we'll take that into account. If we do see, going back to the risk for the revenue, if we do see a large number of jobs which are not created in Seattle but in other parts of the region, that would mean lower employment growth in the city, which means less B&O taxes, payroll expense tax being negatively affected. Again, that initiative 137 is something that the city would receive. It would lower the payroll expense tax revenue that the city gets to receive. For REIT revenues, for example, lower demand for office space in general lowers the asset values for real estate located in the city. And whenever there is a transaction that involves a sale of those properties, city collects REIT revenue on top of that with lower values of office towers, sort of a lower demand for office space means less REIT revenues. Sales tax, again, fewer employees present means less revenue in restaurants located around the cities. Then the other thing that would matter where exactly those people reside, how much they go to the office, depending on the residence of the person. The purchases made by that individual might not be subject to the sales tax, and that's again is something that's harder to take into account. But if a person job is located outside of the city of Seattle, that person might reside in Seattle and commute if it's easy, in which case the sales tax would not be strongly affected. On any purchases by the person. But if the person decides to locate and reside closer to the office, which is further away from Seattle, we are losing the part of a sales tax revenue where the person making online purchasing, driving outside of Seattle, it's not something to the local sales
Sales
tax in the
tax.
city, but
Yeah.
the sales tax jurisdiction where the person decides to relocate.
Ben, did you have anything else? Councilmember Ritter?
Just following up, kind of, some of that. If you're an employer in the city, you've seen the payroll tax come on, you've seen it increase once, you now see a risk of it increasing again. There's just an inherent uncertainty now about kind of what is this, and that creates its own incentives.
Didn't it increase twice?
There were proposals to increase it every year. The payroll expense tax increased once last year.
Last year,
And,
yeah.
and this would be another increase. So
This would be-
depending how you
yeah.
count the first, when it was introduced as an increase from 0 to
Mhm.
Yeah.
initial
And
rates, then the increase
opposed-
next year, and this would be the third.
I suppose,
The
you know,
third.
B&O is kept up over time, but it has a cap sale. It's bottom line in some uncertain. On the who will fill the jobs thing, classic way for economies to respond in short term is with immigration, whether that's at a national scale or a local scale, right? And I think we see that in terms of the diversity in this region's population as the tech sector has exploded. Some of that is driven by immigration. And interestingly, national scale, a lot of this general recognition of one of the reasons that we potentially have engineered a soft landing, although all of a sudden there is about that, is that immigration has actually helped keep the job market relatively open and kept pressure down on wages. So, again, despite all the political rhetoric, it actually probably has been a key driver in making the economy continue to grow financially constrained space. So that is, yeah, so at both local scale, and that means bringing outside the region at a national scale, outside the country.
Thanks, Ben. Yeah, I just wondered long-term what that would do to the forecast if that figure just keeps expanding.
But I mean, long-term growth of US, you know, constrained potentially by the number of people who are there to work.
Who are
It has been a
eligible.
constraint for us for a long time. But our economy where it is, and again, immigration is a classic solution. You have to get your head around it. This is struggles.
Thanks, Jan. I believe that this brings you to your conclusion.
That's the final conclusion.
There we are.
Yes, so we, after discussion, acknowledging all those risks, we do recommend the baseline scenario for both regional economic and revenue forecast. And taking into account the fact that balance of risks likely move towards downside, but we do believe that the baseline scenario one that would be the closest one to the actual outcomes, or is most likely closest.
With that, is there any more discussion? I know that we've just had discussion throughout the entire presentation. That's great. It's easier to have it that way. So if there's no further questions, we'll move on to formally approving this forecast. So per the ordinance that created the forecast office in the forecast council, the role of the forecast council, review and approve the forecast. In terms of approving the forecast, we concur with this recommendation. No formal vote is required. The goal of the legislation was to remove risk of political influence over forecasting and receiving recommendations from staff of independent experts, which you all are. That said, we are all separately elected, so I am comfortable with recommending the baseline scenario. Is there any opposition to that? I'm seeing none. So with no objections, I'll direct the forecast officer to report of concurrence with the recommended forecast of the baseline August 2024 revenue. Anything else for the good of the order?
Just a question about whether this information is already public. Or can we talk about it, I guess, is my,
We're on TV right now.
This is.
yeah,
the
that's
live
what I
TV.
thought, but I came a few minutes late and I wanted to make sure.
No, just to be clear, it was not public until you walked in, if you will, and
Okay,
this is when it
Great.
was made public, and it's done so simultaneously with the executive, and the council. This is the eventual structure of the forecast office.
great, thank you.
Materials we have presented are available on our website.
Great.
We will post the forecast tables as spreadsheet files.
Thank you, Jan.
Which is also part of how we've changed our own budget process at council, bringing Jan to council, because in the past, we just, if you wanted to know, you had what here.
The next meeting in October, the next update, plan is actually to have the meeting structured to include the remaining council members as essentially visitors to the meeting, so that everybody gets it all at once. Otherwise, there's a briefing planned later this week for the remainder of the council, so that way, it's an efficiency thing and an effective thing, but a new approach, when it makes sense, so.
Well-
Raising that item.
I appreciate it too, especially because it gives us the opportunity to ask questions in a way that we're not able to if we're just reading it online or watching the presentation. So thank you for that ability to ask questions, even though I was just here observing. Yeah.
And, kind of just saying what Director Noble said, this becomes our formal agenda. We are adjourning, and I'll remind colleagues in the public, we will have another forecast council meeting on October 22nd. We will roll it in, so you all be with us down in the chambers rather than up here in 370. And Jan, I know that you'll be presenting at committee this Wednesday, so we're excited to have you there. If there are no further questions, we are.